But I want to touch on another market signal. Commodity prices, we know when bonds started falling, commodity prices started rising. This is an asset that benefits when there's inflation. And during the period where the central banks were tightening, really, commodity prices didn't drop. They went sideways and have recently started to rise again. And so you've got bonds starting to sell off again and commodities starting to rise now that we are seeing the central banks become looser with monetary policy. It may be that they don't have the resolve to really truly fight inflation because they need growth in the economy for tax receipts. So gold has been a big topic recently, and I almost was apologetic about talking about gold earlier in the year because, well, it's an asset class that not many people have made money in over the last 15 years. But when we see a shift, we have to recognize it. So a number of months ago, these are monthly bars. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months ago, gold started to break out in price. And I think, we own this in our macro portfolios. We own gold, some gold equities in our equity portfolios and income portfolios. And it has been marching higher ever since. So the question I'm getting right now is, well, it's come a long way. Our equities that we've been in through the course of the year are up 75-ish%. Is it getting overdone? So I wanted to just start in on the call today and just talk about this briefly because we've been doing a lot of thinking about this. But one of the ways we look at what happens when a sector gets overbought is we track how the price is reacting relative to a long-term moving average. This red line is a smoothed moving average of the previous prices from the previous 200 weeks. So first of all, we know we're getting into a bull market when the moving average is moving higher. It means the average price of the previous 200 days has been rising. It's a sustained rally. But eventually, we'll start to move away from the moving averages. So you can see we are currently, as of this afternoon, about 42% above the long-term moving average. And we talked about this when we were looking at semiconductors earlier in the year. If we go back and look at the last bull market after long saucer-shaped bear market and a consolidation, very similar to this saucer-shaped bear market and consolidation, the first leg of that bull market went on and peaked at 85% above the long-term moving average. We are currently 32%. That's almost 50% higher against the moving average. Now that's one leg. Then the market corrected. It corrected for 18 months. In the second leg of the bull market, again, it peaked out 83% above the 200-week moving average. Then it corrected. A long-term bull market has corrections along the way, just like stock bull markets do. And in the third leg, which is typically the strongest, it wound up at 78% above the moving average. But by then, the trajectory, the moving average is moving higher. So when you add it all up, gold was up 345% between 2004 and 2011. That's a big move. Now, so we're sitting right now 32% above. So I would say that based on this, and we don't make long-term decisions on this, we look for change. And if there's change, we act on it. But I would say that 32% above the moving average is very early stage bull market. And you can see it in the way that people are behaving. They're only just over the last couple of months gone from selling gold to buying gold. Now let's look at silver because silver is an interesting animal. It's highly correlated to gold. It tends to start to work later, but it does tend to have higher beta or higher volatility. It does tend to have a more accentuated move. You can see that over the last number of months, again, we broke out of a long range consolidation. We're sitting now 42% above the long-term moving average. Let's take the lens back again. Now, I'm going to look at the bull market of the early 2000s, like we just did in gold. The first leg higher would end up 82% above the long-term moving average, the second 134%, the third 114%, and the last one 150% above the long-term moving average. Again, this pales in comparison. But if we really want to go back and look at our bull market in precious metals, you have to look at the period of the 1970s to 1981, where gold peaked at $1,000. In the first leg of that bull market, it wound up 216% above the long-term moving average. And in the blow-off top, 500% about the long-term moving average. Now, we are not in the business of predicting anything. We're in the business of recognizing a change and dealing with it. Our job is to get into strong securities or strong assets that serve a purpose. If we're in an inflationary environment, these assets serve a purpose. They are a hedge. As I mentioned, gold has been less volatile than a treasury bond for the first time in 45 years. It's been more consistent. But I do think we have to understand the range of possibilities, and I think that this is relatively important. So what could drive it? We talked over the course of the week about the fact that Samsung has a new battery for EVs that ranges 900 kilometers, roughly double the current batteries. They charge in 9 minutes, but they take 32 ounces of silver to build them. Maybe that's something. We know central banks are adding both silver and gold to their reserves, but we think that this is a big issue. This expanding deficit. We take out the pandemic years, but this trend is not getting better. US at a $1.8 trillion deficit this year. So let's look at inflation's killer in 1981, what Alan Greenspan had to say about deficits and gold. In the last significant bout of inflation, he said, deficit spending is simply a scheme for the confiscation of wealth. Gold stands in the way of this insidious process. The abandonment of the gold standard made it possible for welfare statists to use the banking system as a means to unlimited expansion of credit. In the absence of the gold standard, there's no way to protect savings from constant confiscation through inflation. So he said, gold is a currency. It is still, by all evidence, a premier currency where no fiat currency or paper currency, including the dollar, can match it. So we'll see. But I do think that this is interesting. I do think it's important to understand things that have happened in the past. And, you know, treasuries are more volatile than gold. Gold is providing a hedge. And, you know, again, I put this up earlier in the fall. At the end of the previous major precious metals bull markets, precious metals make up significant portions of people's portfolios. And as it sits midway through 2024, the average portfolio about 1% precious metals. So it's been the best performing asset this year. Of course, we'd always love to have more of it, but we are very careful not to overweight. I think that across the firm, we're about 8% precious metals. And that likely will grow as prices move higher. But this is certainly a story to watch and something that's important. So